The stock market crash is coming, and it could be the best financial news that you've ever heard. Sounds crazy, but let me prove it. If you would invested $10,000 during the 2008 meltdown, when everyone else was selling in panic, you would have over $58,000 today without adding another dime. If you had bought during the crash of 2020, your portfolio could have doubled in less than 18 months. And yet, over 70% of retail investors sold at a loss during those crashes. Why? Because panic feels safer than patience. Today, I'm showing you how to be in the 30% that turns fear into fortune, and why you may never see opportunities like this again in your lifetime. Let's go. A crash feels like an end of the world, but history says that it's more like a clearance sale. The US stock market has survived every single recession, depression, war in the last 150 years, and still delivered about 10% per year on average. Let me bring you some facts. So, since 1900, 10% correction happens about every 2 years. A 20% bear market happens every 7 years. And still, the market's long-term trend looks like a staircase going up. So, in 1987, the Dow Jones fell 508 points in a single day. That was 22% wiped out overnight. People thought that it was the end of the Wall Street, but within just 2 years, markets were hitting new heights again. From a psychological point of view, markets are the mirror of human behavior, and humans overreact. Fear spreads faster than facts, which is why the prices fall faster than they rise. Even the Great Depression, when the market fell nearly 90%, was eventually followed by the recovery so strong it created the modern American middle class. The 1970s brought oil shocks and double-digit inflation. The Dow went nowhere for an entire decade, but investors who reinvested dividends still doubled their money. The lesson is volatility is temporary, progress is permanent. The ugliest days often hide the biggest gains, which brings me to one of the strangest investing truths in history: dead investor stat. Fidelity once studied their best performing accounts and found that most belonged to people who were either dead or had forgotten that they even had an account. Why? Because they didn't sell during panics. I have more data for you. So, missing just the best 10 days in the market over the last 20 years cuts your returns in half. And those best days almost always happen right after the worst days. For example, in March 2009, just 7 days after the bottom of the financial crisis, the S&P 500 jumped 6% in a single day. So if you had sold out the week before, you would miss the turning point of the decade. Compounding is ruthless. $10,000 growing at 10% annually turns into $26,000 in 10 years, $67,000 in 20 years, and $174,000 in 30 years. But miss just few years because you sold during fear, and the snowball never gets that momentum. Look at Japan's lost decade. After 1990, 20 years of flat returns. But even there, disciplined dividend investors and global allocators still build wealth. The market punishes those who quit, but rewards those who endure. In a minute, I will show you what those best days actually looked like and how they can turn a losing decade into one of the most profitable runs in market history. In 2008, Apple dropped 56%, but now it's up over 2,000%. Amazon fell 64%. Now it's up over 3,000%. Microsoft fell 45%. Now it's up over 1000%. So if you would invested just $5,000 evenly into those three in January 2009, you would be sitting on about $190,000 today. So we need to change the mindset. Crash isn't a signal to exit. It's your best entry point in years. From a psychological point of view, we are wired to run from danger. But in investing, danger creates the discount. It's not just the tech giants that bounce back. In 2008, energy stocks collapsed as well. And for example, Exxon lost 40% of its value. But when oil rebounded, so did profits. Healthcare, often defensive in market crashes, has delivered 12% annualized returns since 2000, surviving every crash along the way. The key is balance, because crashes don't just reset stock prices, they reset entire sectors. And it's not just individual stocks. Some of the world's biggest companies were born during crashes. Innovation is often born from recession. So companies like Airbnb, that was founded during 2008 crash, now it's valued at $90+ billion. Netflix, for example, shifted to streaming in 2008. Now it's worth over $200 billion. More than half of today's Fortune 500 companies were born during recessions or bear markets. Tough times spark innovation, lower costs, weaker competition, and customers in need open unexpected doors. But on the flip side, the crashes don't just create winners, they can also destroy entire industries. So 4,700 internet companies vanished after dot-com bubble. 465 US banks failed after 2008. In downturns, the strong absorb the weak. So well-capitalized companies acquire struggling competitors at a fraction of their true value. Market crash is like a forest fire, destructive in the moment, but often clearing the ground for stronger and more resilient growth. So the real question isn't whether the next crash will come. It's how prepared you are to seize the opportunities it creates. What are the mistakes to avoid during crashes? I'll give you a quick list that you can follow. First one, going all in on one stock. It's too risky in volatile markets. Second one, timing the exact bottom. Nobody can do it consistently. Ignoring diversification. When one sector gets crushed, others can thrive. And the last one, panic selling at the bottom. Of course, it locks in losses. You should avoid it. And once you avoid these traps, you can focus on the real playbook for turning a crash into an opportunity. I'll give you my crash playbook that you can use as well. Build a watch list now. Know your target prices before panic hits. Keep 10 to 20% in cash. You need buying power for opportunities. Dollar cost average. System that buys you more when the prices fall. Diversity. Growth, value, REITs, commodities, global markets. Stay invested. The market rewards time, not timing. Something that most investors forget. Crashes don't stop at the US border. In 1997, the Asian financial crisis wiped out 70% of some markets. But that collapse set the stage for 2 decades of growth in countries like South Korea and Thailand. Crashes are contagious, but so are recoveries, which means that smart investors don't just look domestically. They use crashes to buy world-class businesses across the globe at discount prices. And if you are wondering how to tell when a stock is truly at a discount, I've put together a checklist in my ebook. You can get it from the first link in the description, or you can scan this QR code if you are watching on TV. The next crash is coming, but for prepared investors, crashes aren't disasters, they are opportunities. And if you enjoyed this video, watch this one next.